Welcome back to the Deep Dive. If you're just tuning in or looking at the market screens this morning, October 16th, 2025, you're probably seeing something, well, pretty confusing.
Confusing is one word for it. Striking, maybe. Contradictory.
Yeah, exactly. It's like this bizarre split personality day. On one side, you've got absolutely record-breaking euphoria, especially in tech.
Mm-hmm. NASDAQ is just flying. Seems like nothing can stop the AI optimism train.
But then, flip the coin, and you see deep, deep anxiety. Gold is the classic fear signal, right?
The ultimate fear gauge. Historically. And it's not just up. It's smashed through records. Trading above $42.30 an ounce. $4,230.
Wow. So euphoria and anxiety hitting extremes at the same time. That's the puzzle we need to piece together today.
That's the mission, this tension, this divergence. It's the whole story right now.
Okay, let's dive in then. Our source material today is a really detailed, almost minute-by-minute market intelligence briefing for today, October 16th.
Super comprehensive stuff.
And our job really is to navigate this high-wire act the market's performing. We need to pinpoint the things that could tip it one way or the other.
Yeah, the inflection points. Could be earnings, right? Could be economic data, or maybe what the Fed says later today.
Exactly. Those are the things that will decide if this AI rocket keeps climbing or if, the gravity of all this geopolitical stress and rate policy uncertainty finally pulls it back down.
You've basically got these two colossal forces wrestling each other. Force one. This incredible wave of optimism, almost faith, around artificial intelligence. It's like a huge tailwind pushing risk assets up.
And force two.
That's the headwind, a really formidable one. Geopolitical uncertainty. Primarily, the friction between the U.S. and China keeps escalating. Trade tensions.
Which ironically puts pressure on the very supply chains that power this AI boom everyone's so excited about.
Precisely. It's a massive tug of war. And you can see investors are kind of caught, splitting their bets right down the middle.
So let's start with that immediate picture.
Yeah.
What are the futures telling us right now as the U.S. market gets ready to open?
Well, it's looking cautiously optimistic. S&P futures, Dow futures, they're up slightly. Maybe 0.1 to 0.4%, something like that.
Modest gains. But where's the real action?
It's the NASDAQ, no question. That relative strength compared to the S&P or the Dow, it just screams AI fixation.
Investors are chasing that future growth story.
Totally. It feels like they're willing to overlook maybe current valuations or even broader economic signs because they believe AI is this fundamental game changer for productivity.
But here's the twist you mentioned earlier, this growth narrative. It's actually getting support from something that sounds, well, negative for the economy. The idea that the Fed's going to ease policy.
Yeah, the dovish tailwind. That's a huge part of the equation. The market seems increasingly convinced that the Federal Reserve is going to have to start cutting interest rates. Maybe soon.
And what's fueling that belief today? Is there specific data?
Well, a big piece is the Fed's own recent Beige Book, their survey of economic conditions across the country.
Right, the 12 districts.
Exactly. And that report, it confirmed what people were suspecting. There's a clear slowdown happening. Momentum in the U.S. economy is definitely easing.
So the logic is, slowing economy means inflation risks goes down.
Which gives the Fed the green light, or at least the excuse, to pivot, to move away from keeping rates high and maybe start cutting.
Okay, so the expectation of cheaper money helps prop up stock prices, especially those tech stocks that are really sensitive to interest rate changes.
Precisely. Those long-duration growth assets love the idea of lower rates. But like you said, it's a bit of a double-edged sword, isn't it?
How so?
Well, that same expectation of Fed easing, it's putting downward pressure on the U.S. dollar. We saw the dollar index kind of flat, maybe slightly lower, around 98.75 earlier.
When a weaker dollar.
Yeah.
That's usually good for commodities, good for U.S. companies selling overseas.
True, but it also kind of reflects less confidence in the U.S. economy standing out from the rest of the world, less U.S. exceptionalism, you could say.
And we are seeing signs of this slowdown globally too, right? Like, wasn't there data from Australia?
Yeah, Australia's unemployment rate ticked up to a 4-year high. So you see these hints of stress in the real economy globally.
Yet, tech stocks are hitting new peaks.
Yeah.
Which brings us to this core belief system the market seems to be running on. You called it the fragile hypothesis, the Goldilocks assumption.
Yeah, the Goldilocks assumption. This is where things get really interesting, maybe even a bit precarious.
What is the assumption exactly?
It's basically the dream scenario.
Yeah.
The idea is that this AI-driven productivity boom is going to be so powerful, so transformative,
Right.
that it allows the Fed to pull off a perfect soft landing. They can cut interest rates to support the slowing real economy
Right.
without causing inflation to flare back up. Because, the theory goes, the new AI productivity gains will keep costs down, even with cheaper money sloshing around.
Ah, okay. So AI solves everything. We get amazing growth and easy money from the Fed. Sounds pretty good.
It sounds fantastic. Best of both worlds. Robust growth, supportive policy. It's a beautiful story.
But you called it fragile. How fragile are we talking?
Tremendously fragile, I think. I mean, look back historically. These kinds of divergences where the market gets obsessed with just one narrow theme, like tech now, and ignores broader economic weakness, they rarely end smoothly.
It feels very selective.
Highly selective. And if today's economic data, like that Philly Fed number we need to watch, if that comes in really weak, suggesting maybe recession fears are real.
Or if TSM disappoints later.
Exactly. Or if TSM's earnings guidance isn't spectacular, poof, that Goldilocks hypothesis just evaporates and you could see sentiment flip really, really fast, painfully fast.
Okay, that leads us perfectly into the biggest contradiction. This simultaneous rally. Record NASDAQ, record gold. It's just bizarre.
It is bizarre and incredibly telling. Why are people buying the ultimate growth story, AI via NASDAQ, and the ultimate fear hedge, gold, at the exact same time, both at record levels?
What does it tell us?
It's a clear signal about how the big money, the institutional capital, is positioned. It screams bifurcated strategy, meaning sophisticated asset managers are doing two things at once. One, they're putting money to work in what they see as the most compelling growth narrative out there, AI. So they're buying the NASDAQ, tech stocks.
Look, I've got to be in the game.
Right. But two, they are simultaneously buying huge amounts of portfolio insurance, protection, just in case something really bad happens, a tail risk event.
And gold is that insurance policy right now,
Right.
trading above $4,230.
It's the primary insurance policy. And this tells you the fear isn't just about a normal recession, a cyclical downturn.
What kind of fear is it then?
It feels more structural, more geopolitical. Think about who buys gold at these levels. Central banks, for sure, diversifying away from the dollar, maybe given all the trade tensions.
And big funds.
Big funds, absolutely. Using gold futures, gold ETFs as a direct hedge against conflict. Against, U.S.-China flare-ups, maybe something escalating in the Middle East.
So the message from these massive gold flows is basically, we love the AI story, but we seriously don't trust the global stability needed to make it happen smoothly.
That's a perfect way to put it. And it's not just gold either.
What else?
We're also seeing renewed buying interest in the Japanese yen, another traditional safe haven currency.
Okay, so gold and the yen are getting bids.
Yeah. And when you see both a hard commodity like gold and a reserve currency like the yen moving higher alongside risk assets like the NASDAQ, that's a really complex signal.
What's the implication?
It implies that investors think the potential bad event could be really catastrophic, but maybe separate from the short-term AI theme. It's like they're investing in two completely different potential futures at the same time, hedging their bets massively. So if I'm watching this unfold today, NASDAQ strong, gold still climbing towards or staying above that $4,230 mark, what's my immediate conviction check? What should I be thinking?
Your conviction check should be flashing red alerts. If gold stays this strong or climbs even higher while equities are also rallying, it means the perceived risk in the system isn't actually going away.
It's just being managed, hedged.
Exactly. Compartmentalized, maybe. It strongly suggests the conviction behind the rally in stocks is shallow, it's selective, and critically, it's vulnerable, really vulnerable to a sudden reversal.
If one of those underlying fears actually happens.
Right. If there's a real escalation, say, in the Taiwan Strait, or if the Fed suddenly sounds much tougher than expected later today, bang. That portfolio insurance suddenly becomes urgent, and the money that flowed into risk assets could flow out just as fast, maybe faster.
So this simultaneous rise isn't sign of broad strength. It's actually a real-time measure of just how high the underlying anxiety really is.
Precisely. High-octane anxiety hidden beneath the surface of the NASDAQ rally.
Okay, let's shift focus geographically for a moment, because a lot of this AI excitement really kicked off overnight in Asia, didn't it?
Oh yeah, Asia was running hot. The momentum was strong, largely fueled by, two things. First, Really strong earnings came out from ASML.
The Dutch company that makes the super advanced chip-making machines.
The linchpin for the whole semiconductor industry, basically. Their results were good. And second, there was a huge anticipation building for Taiwan's semiconductors earnings, which are due out today.
So that lit a fire under Asian tech stocks.
Absolutely. Look at Japan. The Nikkei 225 index jumped, what was it, 1.27%? Closed way up there at 48,277.
Who led that charge?
Tech giants, SoftBank, massive investor in AI and chips, and Tokyo Electron, another key equipment supplier. They were flying.
But again, that divergence pops up.
Mhm.
Because didn't Japan also release some weak domestic data?
It did. That's the thing. Government data showed core machinery orders actually fell unexpectedly month over month, but the market just shrugged it off.
The global AI theme trumped local economics.
Completely. And you saw the same story elsewhere. South Korea's KOSPI index surged 2.49% to a new lifetime high.
Wow. Driven by.
Samsung, SK Hynix, the memory chip giants, crucial for AI servers, they were soaring. Taiwan's main index also hit a record high, pretty much all thanks to its semiconductor muscle.
Okay, so Japan, Korea, Taiwan,
Yeah.
all caught up in the AI frenzy. Now, contrast that with mainland China and Hong Kong.
Yes, stark difference. Really tells a story. The Shanghai Composite Index barely moved, up maybe 0.1%. Hong Kong's Hang Seng actually finished slightly lower.
Why the weakness there?
Well, it's the direct hit from those U.S.-China trade tensions, isn't it? The restrictions often target China's access to the very advanced tech, driving the rally elsewhere.
Plus, maybe worries about their own economy.
Yes, and that was reinforced by some data showing new bank loans in September weren't as strong as expected, suggests maybe businesses and consumers are being a bit cautious.
So the AI party kind of stops at the border,
Mhm.
right at that geopolitical fault line.
It seems that way. Which brings us smack bang into the supply chain risk. Because the companies leading this global tech surge, TSM in Taiwan, Samsung and SK Hynix in Korea, they are right at the geographic and technological epicenter of this U.S.-China competition.
Especially around those most advanced chips.
Exactly. And the risk here is huge. And I suspect possibly underpriced by a lot of equity investors right now.
What do you mean?
Well, everyone's focused on the obvious thing. Soaring demand for chips. That's easy to see in an earnings report, right? More chips sold, more revenue. First order effect.
Okay.
But they might be underappreciating, maybe massively, the second order risk. What happens if the supply chain gets disrupted? What if politics interferes?
But if the U.S. tightens restrictions on China even more?
Yeah. And then you have to consider how Beijing might retaliate. They're not without leverage.
The rare earth minerals threat. We keep hearing about that.
And it's not just talk. It's a genuine vulnerability for the entire global tech ecosystem. China dominates the mining and processing of these 17 critical elements.
What kind of elements are we talking about?
Things like neodymium, dysprosium, names you don't hear every day, but they are absolutely essential for modern electronics. Strong magnets in EV motors, high-performance components in data centers, smartphones, military tech.
Stuff needed for the AI servers themselves.
Absolutely indispensable for the cooling systems, the circuitry, everything. So if Beijing decided to squeeze the export of these rare earths,
It wouldn't just hurt Chinese companies. It could potentially paralyze manufacturing globally.
instantly, the supply chains are incredibly tight. It would send shockwaves through the entire tech sector. And ironically, it would hammer the very companies in Taiwan and Korea that are currently riding high on this AI wave.
So that's a huge kind of unquantifiable risk hanging out there. Investors need to watch for any hints about this, maybe even in TSM's commentary today.
Definitely. Any mention of raw material security, supply chain stability, that becomes critical intelligence. It's the potential Achilles heel of this whole AI rally.
Okay, let's bring it back to the U.S. pre-market action. What are the related markets telling us? Let's start with bonds, the so-called smart money.
Right. The benchmark 10-year U.S. Treasury yield. It eased back a little bit this morning, trading around 4.027%.
Okay, yields down means bond prices are up, people are buying bonds. Why?
Two main reasons, probably overlapping. One is that classic safe haven bid. Investors are nervous about the geopolitics we just discussed, so they buy treasuries for safety.
And the second reason?
It's that expectation of a dovish Fed again. If the market thinks rate cuts are coming because the economy is slowing, that pushes longer-term yields down too.
So even as stock futures are pointing up slightly, the bond market is flashing caution, buying safety.
Exactly. That's the divergence right there, playing out live. positive equity futures, but the bond market is voting for safety and lower rates.
Why should we maybe pay more attention to the bond signal?
Well, bond investors tend to think longer term. They're usually more focused on risk management. So when they're buying bonds, even as stocks look okay, it suggests they have a higher conviction that either, one, long-term growth is going to be weaker than stock investors think.
Meaning the AI boom won't save the day quickly enough.
Right. Or two, the geopolitical risks are more serious, more acute than the stock market is currently admitting. Either way, this disagreement between stocks and bonds, it suggests the foundation for this morning's equity rally might be pretty shaky.
Fragile. There's that word again.
It feels appropriate. If today's economic data confirms the bond market's fears, that equity rally could evaporate fast.
What about other commodities? Oil.
Oil's firm. WTI crude around $58.81, Brent near $62.33. Partly geopolitical factors there, too. There were reports about India maybe halting Russian oil imports, which could tighten supply.
And gold, our anxiety gauge.
It's still stubbornly high, above 42.30, refusing to back down.
But the VIX, the main volatility index.
Relatively calm, actually, around 20.71. It's not screaming panic like it does in a major crisis.
So caution, not panic.
I think that's right. It suggests the fear is being hedged through gold, maybe bonds, rather than leading to outright selling of everything. It's like the market is whispering its anxiety while trying to shout optimism.
But if you want to see pure, unadulterated speculation, maybe detached from the big macro picture, you look at the pre-market movers.
Oh, yeah. That's where things get wild. The short-term volatility driven by news, algorithms, retail traders. It's incredible.
Let's talk about the one that jumped out this morning. Australian Oilseeds Holdings, ticker COOT.
Unbelievable. Up over 300%, 303.1% last I saw.
300% on what amazing earnings. A cure for something?
Nope. The catalyst was apparently comments made by former President Trump, something about U.S. policy towards China, and tangentially mentioning cooking oil.
Cooking oil. And that sends an Australian stock up 300%.
Within seconds, it seems. Algorithmic trading systems likely picked up keywords, retail networks jumped on board, and boom, massive speculative buying frenzy.
That just shows how quickly political noise can become market reality now.
It really does. Instantaneous translation. Shows the power of liquidity, network effects, and automated trading. We also saw other big moves on more tangible news.
Right, like Omeros Corp, OMAR.
Yeah, up 182%. Novo Nordisk bought one of their assets, huge validation for their drug pipeline.
And Genpri, GMPX.
Up 90%. Positive clinical data for a cancer therapy. That's the kind of news you expect to move a biotech stock.
We also saw Salesforce, CRM, a big tech name, up over 7%.
Yeah, strong forward guidance from them. That feeds right back into the positive AI sentiment, helps the NASDAQ.
In the flip side, the bears are retreating.
Seems like it. The inverse semiconductor ETF, the SOXS, which bets against chip stocks, that was down over 7% pre-market. So broad bullishness in the chip space.
But that COOT example, the cooking oil stock, it really makes you think about the market structure itself, doesn't it?
It demands, you think about it, it shows how geopolitical statements, even seemingly tangential ones, can be weaponized almost instantly by trading algorithms and social media hype. It creates this intense, unpredictable, event-driven volatility. It's a new source of risk, isn't it? Headline risk might actually be the most volatile catalyst now.
Capable of generating these insane moves based on almost nothing fundamental.
Exactly. Raises big questions about how HFTs amplify noise, about regulation. It suggests that even if the underlying tech story is solid, the market plumbing around it is maybe geared to magnify speculation on any political twitch.
Wow. Okay. So
Yeah.
against that backdrop, we head into a massive day for earnings. And the biggest one, the global focus, is Taiwan Semiconductor, TSM.
Yeah, TSM's report coming out pre-market isn't just another company result you said earlier. It's basically a global macroeconomic event today.
Because they make the chips for almost everyone.
They're the foundry. They manufacture the most advanced chips for Apple, NVIDIA, AMD. Everyone relies on them. So their results, and especially their outlook, tell us about the health of the entire tech ecosystem.
What are the expectations?
Pretty high. Consensus is looking for earnings per share around $2.59. That would be up like 33.5% year over year. Big growth.
But just hitting the number isn't enough today, is it, given the hype?
Probably not. The market needs more than just a beat. It needs confirmation. It needs confidence. There are three things everyone will be laser focused on.
Okay, number one.
First, the demand story for AI chips. Is it real? Is it durable? TSM needs to confirm that demand for their most advanced manufacturing processes, the ones making those high-end AI chips, is not just strong, but sustainably strong. Is this a multi-year super cycle or just a temporary surge?
They need to say the pipeline is packed for the foreseeable future.
Exactly. Number two.
Number 2, capital expenditures,
Yeah.
CapEx. How much are they planning to spend building new factories, buying new equipment?
Why is that so important? Because CapEx is the ultimate signal of confidence in future demand. If TSM announces massive spending plans, pouring billions into expansion, the market reads that as, wow, they really believe this AI boom is huge and lasting. That could send the Nasdaq soaring.
And if they're cautious on CapEx, even if the current quarter was good.
That's a red flag. It raises questions. Are they worried about demand down the road? Or are they worried about competition? A cautious CapEx number would definitely temper the enthusiasm.
Okay, demand trajectory, CapEx confidence.
Hmm.
What's the third key point?
It links right back to our gold discussion. Geopolitics. Supply chain stability.
Any mention of China-related issues?
Precisely. TSM operates right there in the geopolitical crosshairs. Investors will be listening intently for any comment, even a subtle one, about potential disruptions, difficulties getting materials like those rare earths, or increased costs because of political tensions.
That could be the pin to prick the bubble.
It absolutely could. If TSM sounds worried about the stability of their operating environment, that instantly validates all the hedging we see in gold. It could overshadow even good financial numbers.
Okay, so TSM gives us a global tech pulse, but we also need a check on the U.S. economy's health, right? And we get that for the big U.S. banks reporting today.
Yeah, it's a crucial triangulation. We get the financial plumbing check. Let's start with Charles Schwab, SCHW.
What's the focus there?
Two things mainly. Their net interest margin, NIM. That's the profit they make on the difference between interest earned and interest paid out. With rates high but maybe peaking, how well are they managing that spread? It tells you about pressure on deposits.
And the second thing for Schwab.
Client asset gathering. Are retail investors still putting new money into the market through Schwab, or are they pulling back? It's a great proxy for Main Street sentiment.
Okay, then there's BNY, Mellon, BK,
Yeah.
the giant custody bank.
Yeah, with BNY Mellon, it's less about traditional lending and more about fees. So you watch their fee-based growth. Are they earning more from managing and servicing assets? That gives you a window into what institutional capital is doing globally.
And their costs.
Right, operating leverage. Can they grow those fee revenues without expenses growing just as fast? It shows efficiency and discipline. Strong flows into BNY Mellon suggest market depth.
And for a direct read on consumer and business health on Main Street,
Yeah.
U.S. Bancorp, USB.
Exactly. USB is more of a traditional lender, so the focus is squarely on loan growth. Are businesses and consumers still borrowing? And crucially, credit quality.
Are people paying their loans back?
That's the question. You look at their provisions for credit losses. How much money are they setting aside because they expect loans might go bad? If loan growth is slowing and provisions are rising sharply, that's a clear warning sign. It means the economic slowdown mentioned in the Beige Book is starting to bite.
We also have Travelers, TRV, the insurer.
Yeah, focus there will be on catastrophe losses, obviously, given recent weather events. Insurance costs feed into inflation, too.
And later today, after the market closes, CSX Corporation, the railroad.
CSX is super important. A railroad's traffic volume is like a real-time EKG for the industrial economy. What are they shipping? Intermodal containers, cars, coal. It tells you if factories are busy, if goods are moving. It cuts through the survey data and tells you what's actually happening on the ground.
So taken together, TSM and these financials, they'll either confirm the AI optimism or validate the bond market's caution.
It's a huge day for that reality check.
All right, shifting from companies back to the big picture macro data. The first major test comes right at the U.S. market open, 8:03 a.m. Eastern, the Philadelphia Fed Manufacturing Index.
Yeah, this one's always closely watched. It's forward-looking, asked manufacturers about their expectations, and the market is definitely bracing for a slowdown here.
What's the consensus forecast?
Looking for a reading of 10.0. Now, that's down sharply from 23.2 last time, so a definite cooling.
But 10.0 is still positive, right? Above 0 means expansion.
Technically, yes. So a result right around 10 might actually be okay for the market. It fits that slowing momentum narrative that supports the idea of Fed rate cuts. Not too hot, not too cold, maybe Goldilocks territory.
But what about the extremes? What if it's much worse than expected?
Okay, that's the risk. If this number plunges, say, below zero, maybe -5, -10, that could set off serious recession alarms. It would make the bond market look right, and it could really undermine that whole risk-on mood, hitting everything except maybe gold and treasuries.
And the other extreme, what if manufacturing is surprisingly strong? What if it comes in back near 20?
Ah, the good news is bad news scenario. If manufacturing is still robust, it challenges the whole narrative that the Fed needs to cut rates soon.
Because a strong economy means inflation might stick around longer.
Exactly. So a strong Philly Fed number could force the market to quickly rethink its Fed bets. Rates expectations adjust higher, and that's typically bad news for growth stocks, especially tech. Could trigger a sell-off.
So that Philly Fed number is a real litmus test right at the open. And then, adding another layer of potential volatility today, we have a whole parade of Fed officials speaking. You called it Fed speaker roulette.
It really is. It's an unusually packed schedule, especially in the afternoon. And it's happening at a time when the market is incredibly sensitive to what the Fed says, because everyone's positioned for those rate cuts.
Who's on the docket?
Let's see. We've got Governor Birkin from the Richmond Fed at noon Eastern. Then, at 1:00 p.m., it's a potentially powerful duo. Vice Chair Barr and Governor Waller speaking together.
Waller's seen as influential, right? Maybe a bit more hawkish.
Very influential, often acts as a counterweight when the market gets too carried away with dovish expectations. And then after them, at 2:00 p.m., we have Governor Bowman.
Okay, so Barkin might talk about regional conditions, inflation. Barr focuses on banking stability, which ties into the bank earnings.
Right, Barr's comments on credit quality will be key after we see the bank reports. But that 1:00 p.m. slot with Barr and Waller, that's the main event, risk-wise.
Wind them together.
It suggests maybe a more coordinated message could come out. And given Waller's recent tone, if there's going to be pushback against the market's rate cut enthusiasm, he's likely the one to deliver it. The market desperately wants the Fed to just confirm the Beige Book's findings and nod along.
So if Waller especially comes out strong and says, hey, market, you're getting ahead of yourselves on rate cuts, inflation is still the priority.
That is the single biggest threat to the equity rally today, period. It could override good news from TSM. It could override a soft Philly Fed number.
Fed policy trumps everything.
Almost always, when there's a direct conflict. If Waller delivers a convincingly hawkish message, you'll see rate expectations shift instantly. Yields would likely spike higher.
Crushing tech stock valuations.
And potentially triggering a broad market sell-off. The Fed speakers, collectively, hold the power this afternoon to completely rewrite today's narrative, regardless of what happened earlier.
So the nightmare scenario for bulls is TSM's okay, Philly Fed is soft, but then Waller steps up and pours cold water on imminent cuts.
That's the textbook risk-off trigger. Policy clarity, especially hawkish clarity, will dominate corporate optimism every time. That's why those afternoon comments are the final and maybe most important piece of today's puzzle.
Okay, so let's try to wrap this all up. What does this incredibly complex, contradictory setup mean for you, the listener, trying to make sense of it all today?
Well, I mean, it's clear today is shaping up as this direct clash, isn't it? It's sentiment, AI momentum, this almost intangible belief going head-to-head with concrete risks, geopolitics, real economic data, potential Fed pushback.
And the winner, the direction for the day, really hinges on just a few key things interacting.
Yeah, boils down to three main forces, I think. One, TSM's guidance, does it fuel the AI fire or dampen it? Two, the Philly Fed number, does it scream slowdown or surprise with resilience? And three, arguably the most critical, the overall message from that Fed speaker lineup this afternoon. Hawkish or dovish?
So let's sketch out the possible outcomes for today, just briefly, so you can think about your own risk positioning. Scenario one, the bullish case.
Okay. Bullish, risk on. That needs a strong TSM report, confident outlook. It needs the Philly Fed to be soft but not scary, say, in that 8 to 12 range, confirming a gentle slowdown. And crucially, it needs the Fed speakers to sound generally dovish or at least not actively fight the market's rate cut hopes.
And if that happens?
NASDAQ leads the charge higher, tech rallies. And importantly, you'd expect those safe havens, like gold, to finally give way and sell off sharply from that $4,230 level. The anxiety eases.
Okay. Scenario two, bearish, risk off.
That's the opposite. TSM comes out cautious, maybe on capex or supply chain worries. The Philly Fed number is ugly, plunges below zero, sparking real recession fears. And then the Fed speakers, led by Waller, deliver that hawkish surprise, telling the market it's wrong about imminent cuts.
Result.
Broad sell-off, probably violent, tech gets hammered, the VIX index spikes, and gold likely surges even higher as fear takes over completely.
And the third possibility, the middle ground.
Yeah, the mixed and choppy scenario, which frankly feels pretty plausible given all the conflicting signals we started with. Maybe TSM is just okay, not great. Maybe the Philly Fed is ambiguous. Maybe the Fed speakers send mixed messages, some hawkish, some dovish.
What does the market do then?
It probably thrashes around. Volatile, range-bound trading, no clear direction. Money would likely rotate rapidly between sectors as different headlines hit the tape. Defensive stocks might do okay one minute, tech the next. Makes for very difficult trading.
So 3 very different potential paths today. Now that story about the Australian oilseed stock, COOT, jumping 300% on political comments, that was just wild.
It really was. A political statement about China and cooking oil triggers a triple-digit speculative mania in seconds.
It leads to a really provocative final thought, doesn't it?
It does. You look at the current environment, you've got tons of liquidity sloshing around, you've got intense geopolitical friction like that rare earth threat we discussed, and you have these incredibly fast automated trading systems scanning headlines 24/7.
So the question is
Is the market's actual structure, its plumbing, now fundamentally designed to amplify this kind of geopolitical noise? Does it turn political rhetoric into the most volatile, unpredictable market catalyst of all?
and if that's true, what does it mean for managing risk? If a single comment can cause a 300% swing completely unrelated to fundamentals,
Yep.
how do you protect your portfolio?
If that kind of instant automated speculation overrides traditional analysis, how do you even define risk anymore? It's a profound question. Definitely someone to keep in the back of your mind as you watch these incredibly complex markets unfold today.